Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Friday, October 25th, 2024. Today's episode, I want to bring up a subject regarding a red flag that people feel rich right now. I have a friend that basically works for grants, people that are involved with grants. Grants are places that rich people can spend money and, on whatever. And there was an investment advisor at one of these meetings advising people that, yes, now is the time to get your grants going, to get into these grants, because rich people especially with major tons of investments, they feel awfully rich right now. You consider how high the stock market has gone, especially, considering how high it's gone compared to its valuations right now. Think about how much the price of real estate has been really ballooning up. We are currently sitting in a period where people feel very wealthy. And I just want to bring this up as sort of a red flag to suggest that when we do get to the part of the business cycle when things turn around, they're going to turn around, I think, a lot harder. I think they're going to have a much stronger effect than people think. This whole narrative as well about inflation, being a major concern, taking off to the moon. The 10-year break-even rate is still at only about 2.3%, not getting out of hand. One way to look at this too is that we recently had, you've seen on a bunch of finance shows about how the fiscal deficit just spikes recently, and how, all of a sudden there's this uptick in government spending. And therefore, people think that that's going to lead to runaway inflation and that you got to go into gold and stocks. It's the only place that you can go. And my answer to that is no. Think of what would be going on if they were not increasing the deficit this quickly right now. And, one way to look at this is maybe these fiscal deficits are the only thing keeping us afloat right now from a major, slowdown. You look around the world, all of the other major world economies are, they're not feeling rich right now. They're in the deflationary, depressionary kind of situation, namely China. My crystal ball says we would be exactly in that situation if it wasn't for the amount of fiscal spending. Another idea that I just want to put out there with yields being so high compared to the valuation of stocks is that, even Benjamin Graham in Security Analysis, right in the very first chapter, and it's either in the intro or the chapter, he mentions how you can have a situation where PE ratios go way up and yields go way down if there's too much capital chasing too little amount of investments. And that can be said for what's going on here, especially looking at the stock market. Now, that hasn't happened yet in bonds, but when it does, when we get to that part of the cycle where stocks go down and money starts flowing back into bonds, it's going to be a tidal wave of money. It's not going to be like a little bit of money. And I think rates are going to get slammed way lower than anybody else thinks out there right now. I think I'm the only person out there putting that viewpoint out. And I think there's a lot of validity behind it, but I'm just a guy with a crystal ball. Next on today's episode, Western Digital came out with solid, strong earnings. It's a semiconductor company, and their stock rose today. I want to bring this up because I've been talking about being short in semiconductors in general. So this came out with strong earnings. Now that might make you think, oh, well, semiconductors must have done really well today. Well, let's first start looking at the Western Digital Corporation itself. It opened almost 10% higher on the day. By the end of the day, only about 4.7% higher. And if we move over to the SMH, the ETF of semiconductors, today's candle doesn't look like much of anything. We are very much still solidly in this gigantic engulfing red candle within this wedge, within this topping head and shoulders pattern after a bearish white whale double engulfing candle. This is just, it's primed to just shoot down from here. And my crystal ball says that it will take a lot of the market with it. Again, with the old adage, trees can grow very tall, but they don't grow forever. Railroads.com companies, over and over again, the market prices as if it's just going to keep getting bigger, keep getting bigger, keep getting bigger. Eventually, it stops. Eventually, we realize, okay, yeah, these companies make are making a lot of money and can continue to make more money, but not as much money as the market has been pricing. I think we are at that part of the stage when the market is waking up to the reality that, at the end of the day, semiconductors are not a Nike shoe brand. They're not an Apple iPhone. These have no wide moat. It's a commodity. And any company, all of these companies are competing to make these things. You may or may not have seen the headline on Yahoo Finance this morning regarding Intel talking about opening two more, not one, but two of their own semiconductor plants, two more plants making semiconductors, and they decided to withdraw it. They're not going to make these anymore. That's an alarm bell here, folks. Intel, a giant company, is saying basically that it's not worth the investment. Although semiconductors have been making a lot of money, this is like the first sign to me that, there's a limit to how many companies there's a limit to the amount of profit that these companies can make, because once we have overproduction of semiconductors, which will happen, guaranteed to happen, profits will go down. And, as these companies compete with each other's prices, earnings are going to contract majorly here. They're not just going to stop growing, they're going to contract. This industry is set to crash majorly, in my strong estimation. Again, no investment advice. You're literally watching a guy with a crystal ball. Here are the daily reminders. I'm not going to read through them today. To watch me read through them, watch Monday's show. Every Monday, I go through the daily reminders. Also, the crystal ball reading remains bear market very soon. Fed won't cut fast enough to save the economy. I am expecting unemployment to spike. I am expecting bankruptcies to rise. I am expecting treasury yields to drop. I'm expecting credit spreads to spread. I'm expecting us to be looking back at today in the near future and people saying, oh, well, all the clues were there that we were headed straight into this storm. Last thing before we go through the charts, thanks for watching, and feel free to support the channel. Many chartists are noting that we've broken down to the downside out of this rising wedge on the S&P 500, suggesting more bearishness ahead. To my eye, just from a basic layman's view of this, it does look like it's rolling over. I'm I mean, we're so close to that 6,000 mark. I almost kind of want it to get to 6,000 just to satisfy my need for round numbers. It's like, just get there, and then we can fall down. Again, like I say every show, this market is extremely overvalued. The PE ratio being 30, all while treasury yields are over 4%. There's a mismatch here that doesn't make any sense whatsoever. Although the S&P 500 has been sort of going flat near all-time highs, the VIX having a good pop today above that magic 20 level. This is this is just elevated. Options are pricing in fear here, so much so that the entire VIX futures curve is now completely inverted. Completely inverted above the all the way out through next June. I wanted to add to this that actually the January contract, very interestingly, is actually elevated above the following 3 months through April. So we're sort of seeing that little hump there. This is like post-election, so a lot of people correctly say how it's typical for nervousness to be in markets before elections and then bullishness to come out of elections. So I find it interesting that we have that little bump here in the VIX in January. I'm not sure what the market's sniffing out there other than, all of the facts that I always bring up with my daily reminders about how scary I think valuations are in equities, along with where we are in the business cycle. Speaking of which, the U.S. Treasury yield curve is continuing to be highly interesting. One of the most referenced yield curves is between the 3-month and the 10-year. So the two main when we talk about inversion and uninversion, what we're really talking about usually most of the time is where the Fed funds rate is related to the rest of the curve, and then what the market expects within the next few months regarding where rates will be in the next few months versus the rest of the curve. And the two main ones people typically watch are the difference between the 2-year and the 10-year. It gives a longer time horizon as to whether rates are expected to stay higher and then go lower at some point in the future. That's when the 2-year is above the 10-year. We uninverted in the 2 to the 10-year, but we're still highly inverted between the 3-month and the 10-year. The 3-month is way above the 10-year. Once the 3-month drops below the 10-year, that's when typically they start talking about in the news how there's just like waves of bankruptcies, no one can get a job, etc., etc. So by all macro data, we're clearly headed straight into that right now. It's coming within maximum 6 months at this point, the way things are going right now. But I wanted to bring up this chart again today because as I noted in a very previous show, the difference between the 3-month and the 20-year now being, let's see here, it's 473 and 458. So this relationship's continuing to get tighter. This is a very interesting time to be. By the way, in normal good times, the left side of the chart is low and it gradually goes up to the right side of the chart. You're not supposed to see this side higher than this side. It means that it's inverted and the markets are pricing in a slowdown in the economy. They are expecting lower rates going into the future. That's what's priced in right now. Something I recently discovered on this same website, USTreasuryYieldCurve.com, is when you click, I think it's valuation. No, it's the time series. Yeah, this one. This one is so cool. This shows the 3-month in blue yield and the 10-year yield in red. And as you can see, the 3-month has been going down, and as soon as we get to the next cut and the market's still pricing in more cuts, this is going to drop. And the 10-year, we haven't, these two lines haven't been this close pretty much since we first inverted towards the end of 2022. Now, a soft landing would be this red line actually going up above the blue line while the blue line staying flat. But the Fed funds futures say we're going to be cutting here, and so this is what we refer to as bull steepening. In other words, the value of the 3-month basically going up while the yield goes down. That's bull steepening. That when you have a bull steepening scenario, that's recessionary, that's depressionary. If the red line is the one that's climbing up and climbs above the blue line while the blue line stays flat or even goes up, that's when you can get that soft landing. Now, funny enough, both things are sort of happening here. You had the 10-year curling up here while the blue line has been dropping. So we'll see how this all plays out. Once again, I'm in the camp that the cuts will be less effective for helping the economy move forward. I think things are going to slow down, and the cuts they're not going to have hardly any effect, and it has to do with the large deficits. Now, say the economy is just looking absolutely fantastic and the 3-month goes sideways or even goes up a little bit, and then the red line continues its current path up higher and higher. Well, yeah, that would be what a soft landing, there's a chance of a soft landing in that scenario. Now, with it being inverted for so long, and the fact that this pretty much never happens that way says that, I don't think we're headed to a soft landing. But again, just a guy with a crystal ball. TLT, still my favorite place to be, appears to be potentially forming a bottom here. I really don't know if, it's no longer so bearish looking. It's not like, it's flattening out. We're not still doing this whole down thing, flag up, down thing, flag up. This is looking like it might even be a bottom here. I'm actually hoping that the 10-year yield, that's what this chart is, gets to this purple line, because I think that's like the target, and that it's just destiny to get there at this point. Again, this is the head and shoulders top of 10-year Treasury yield. Head and shoulders there, break and retest. This has a connection here in March 2021. It would make complete sense. I kind of want yields to go up so I can dump the rest of my cash into TMF. A chart that caught my eye today, XHB Home Builders, has this pretty large engulfing candle. This is starting to look bearish here, actually. DXY, the dollar index, looking like we're finally taking a breather here. I have no idea if this is going to be, flag out and then go higher or continue lower, but we finally stopped going vertically up. Next chart is KWEB, Chinese ETF of Amazon and the Facebook, the Chinese versions of those companies. We had broken out of this wedge to the upside recently, and I was suspecting that we would just fly higher, but I don't know where this is going to go in the short term. Again, I'm targeting $45 to $50 range as being a fair valuation of the companies in this fund. I'm not fair, still cheap, but just not like dirt, blood in the streets, cigarette butt cheap anymore. Right now it's cigarette butt, blood in the streets kind of cheap. So anyway, we are coiling up here, interestingly, and so we're preparing for a breakout. I would suspect it would be to the upside, but I don't know. I mean, it's we could have a scenario from a technical analysis standpoint to break down and sort of retest the scene of the crime, where we broke out, but before getting to a new leg higher. It could end up playing out that way. Lastly, my largest, I think it might even be my only single stock holding, is Nissan, because the balance sheet leaves, if they were to liquidate the whole company, the shareholders would get plenty of money right now. It's like, this is a Graham, from everything that I can tell and calculate from this company, this looks like the kind of stock that Benjamin Graham himself would buy. I wouldn't be surprised at all to find this in Michael Burry's portfolio in his next 13F, because it just seems very obvious to me. I don't really know what I'm missing if it's not in Burry's portfolio for his next 13F. But anyway, we have earnings. The company's earnings are coming out in like a week or two, beginning of November, and we've been coiling up at just like, this is like bankruptcy price, all while the balance sheet is perfectly fine. This company, again, if it were to liquidate, the shareholders would not get wiped out; they'd get paid. So I'm not sure why this stock is getting so beaten down, but I'm getting excited about the potential burst upwards. We've been sort of coiling down for a while, and it looks primed to do a little poparino. Anyway, that's all for today's show. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.